Hello, this is Jordan. This video is being recorded just before the morning of Friday, November 25th, 2022. Hope you all had a great Thanksgiving. And if you're fortunate enough to have Friday off, I hope you enjoy your long weekend. In this video, I'm going to talk about some subtle bullish catalysts that we're starting to see for gold. And so we're getting into the holiday season. Maybe markets get kind of less exciting. There's less volume at times, but we have to really pay attention because the weeks ahead, maybe that determines or confirms for us if a bottom is in for gold. I think there's already enough signs to say that there's confirmation. I said that in the last video, but there's obviously, as you get more and more evidence, you can feel more comfortable thinking that we're in a new bull market and not just a rebound. So that's really the question. Now, what I want to talk about, now there's a lot of things in this chart. I'll go through it. Gold at the top, obviously, it's a daily line chart. We have the 10-year yield, and then we have the spread, the yield curve between the 10-year and the 3-month yield, which inverted a couple weeks ago. We can see now that's really diving. I mean, that's nearly... That if that keeps diving, it's going to get to minus 1%. So that's even that curve is badly inverted. The curve itself just inverted a couple weeks ago. Now it's badly inverted. Then at the bottom we have the Fed funds rate, and so the red lines show when the Fed stopped hiking. Now I also included 1998. It's a little lighter. But the Fed was basically flat for a couple years up to that point, and then they made a change. They started cutting. There were concerns about emerging markets in Russia, and talk about that a little more because I think there's some parallels to today. But anyway, the one big point here, and you can see it in yellow and the blue arrow. It's kind of hard to see on this chart, but the 10-year yield, maybe that has put in a peak in the last month or so. I mean, I'm going to show it again on the next chart. But it's really something to think about. I mean, bonds have had a decent rebound, and look, for the last couple months, even beyond that, there's been all these sentiment indicators that how bonds are just extremely oversold. I mean, the short positions are at record highs. And so if bonds, obviously they're rallying, and if it gains some more traction, just the fact that all that bearish sentiment unwinding, that could give even more legs to the rally in bonds and also more legs to this decline that we're seeing in the 10-year yield. And you can see, if you look at the red line, that's when the Fed stops hiking, the red vertical line, that tends to coincide with when the 10-year yield peaks and declines. I mean, it's not always perfect, but, if you look more at the beginning of the chart, in the night, from 95 to 2001, you could see, there's obviously three red lines, but aside from the one in 98, the one in 95 and 2000, you can see 10-year peaked a little bit before the Fed stopped hiking. They still obviously got another hike. You look at 2006, the end of 2018. So the 10-year yield peaked, basically at the same time the Fed executed its last hike. This time, if the Fed's last hike is going to be in December or January, I mean, it doesn't look to me. I mean, what is the case that the 10-year yield is going to continue to rally and go above 4% at this point? I don't see it. So therefore, I think we've likely seen a peak in the 10-year yield. You don't see this in the next chart, but I've always met, well, that's something about 10. I'm going to stop for a second. That's about the real 10-year yield. So the point I wanted to make about gold is, so we have these 5 lines here. Basically 4 of the 5, you got to rally in gold, or you got to move in gold after the 10-year yield peaked. I mean, you can see even in 1995, you did have a rally there. I mean, it popped at the beginning, sold off a little bit, and then it went up into 1996, made a very significant peak. But, we all know what happened for 2000, 2006, and obviously late 2018. So, and I know that we've been in an inflationary environment, so that's different. from most of the years in this chart, but nevertheless, it's a good bet that the 10-year yield is peaking, and we're going to see more of a rebound. At worst, we're going to see a rebound in gold. I mean, obviously, I think we're going to see a lot more. But now, getting back to the 1998 comparison, if you think about it, 1998 to 2000, very similar to 2020 to 2021, because 1998, I mean, you have the yield curve inverted. You can see there, even the 10-year and the 3-month spread, at least in daily terms, it inverted. I think if you put a weekly or a monthly line in there, it didn't quite invert. But, the Fed, they cut rates at that point. They pumped in a lot, they pumped in a lot of money. They reflated markets. And, we had this huge, people already thought tech was a bubble in 1995, 96, 97. There are a lot of people who thought in 1998, that's it for tech. And, the yield curve inverted. So you had all these, emerging markets were in a bad recession. You had all these warning signs. Fed comes in, they cut rates, and they pump, tons of money in. And you see another leg higher in the bull market in tech. And then it ends, with .coms just going crazy. And it's just, it's very similar to what happened if you think about it, because the yield curve inverted 2019. There were warning signs then. The market already corrected. But the Fed came in, and so they cut rates in 2019. And then in addition to that, you get the COVID crash, and the Fed, they cut rates down to zero again. And then, of course, free money for everybody, the stimulus and the $7 trillion or whatever it was. And we see all that. And then you get this huge, you get another leg higher in the stock market, like a huge leg higher. You get this huge bubble. And then, crypto goes crazy. You have all these, and a lot of tech companies as well. You just have these absurd valuations. So it's very similar to what happened from 1998 to 2000. And so based on that comparison, I don't know, maybe we're in 2001 right now. Obviously the Fed hasn't started cutting yet. Inflation is more of a factor. But I know that's a lot. I know that's a lot to take in just from talking about subtle catalysts from gold. But, the real main point is, you have a peak in the 10-year yield. And, obviously the inversions are really sharp. And so the peak in the 10-year yield, potentially, that's just another really bullish sign for gold, because it's another reason the Fed is going to stop hiking very soon, I think. Next here we have gold at the top. Then we have the real 10-year yield, the 10-year yield, so the nominal 10-year yield, and oil. And so, potentially another subtle catalyst for gold is, you look at oil's at $78 now. If that goes below the September low at 74.75, that's a new 52-week low. If you look at oil and the low it made at the very end of December 21, I think it's 74 or $75. So again, technically look at oil. You can see, nice uptrend. It's bouncing off the 200-day, but if you look since the summer, twice it failed in August at the 200-day. Excuse me. Then it sold off into the end of September. One rally that failed, another rally that failed. You kind of have a mini double top there with the October high at 90, then the early November high, both around 90. And so it's selling off again. It's below the 200-day moving average. So that does, obviously it does not look good for oil. And so oil coming down, potentially breaking towards a new 52-week low, that aligns with the 10-year yield having already peaked. And so these are more signs that inflation is really coming down. And there are also recession signs as well. And so you think this would be bad for gold, but as we can see, based on, the daily chart of gold, triple bottom, or you can call it a potential double bottom. Gold hasn't quite tested the 200-day moving average yet, but it's pretty close. And then we look at the real 10-year yield. Look at there in yellow, which I've highlighted. And that looks toppy to me. So, I mean, since the end of September, the real 10-year yield, despite, I mean, we had the hike at the end of September. Then we had the hike in November, and you're about to get another hike in December. But look what the real 10-year yield is doing. It looks like it's forming a peak. And so obviously, as real yields come down, that's very bullish for gold. So we're seeing some subtle positive bullish signs for gold. I know I mentioned these things, the 10-year yield, I think in July, I want to say, that the 10-year yield had potentially peaked then. It obviously didn't pan out. Same thing for the decline in oil. It really didn't start to come down, I think, until I would say at the end of August. It rallied back up to the high 90s, and after that, then it came down. But that aside, I know I'm babbling on here, but the point is, gold is rallying up towards the 200-day. Oil has broken below the 200-day. So things are moving in favor of gold. We can already see how gold's performing the gold stocks as well. So thanks for tuning into this video. It's longer than I wanted, but I'm still getting over the crud and the flu. I think another day or two I should be completely fine. But let me know what you think. I hope you found something useful in there, and I'll talk to you guys again in the next video.